All right. Welcome to another episode with Strive for 25 podcast. This is Joel Farrell, and I've got a couple guests on today. And, we talk about on this channel a couple of equations, the savings equation, the investment equation, and the results equation. So this one's going to fit into the investment equation because we're going to be talking about the crypto world and the news that's coming out today that has to do with FTX possibly going bankrupt. So Michael Allen and John Wingate. So Michael, can you introduce yourself first?
Michael Allen, active duty military, Coast Guard, but avid, recent crypto investor over the last couple of years. Been a long time follower of crypto and got my interest in it peaked at the height. Learned a lot of lessons, but learned how to stay safe in it, and a lot of that is through education and just learning your way through the crypto world and Web3 world. And then John, if you want to introduce yourself.
Yep, John Wingate. I'm the founder and CEO of Financial and Bank Social and a handful of other companies that are working in the distributed ledger and what most people call crypto space.
Well, let's dig
The-
in. I mean, what is going on? Like the lay person may not know what FTX is and what's going on and all this news. So can you let's just dig
Yeah.
into this. What is going on out there?
So, yep, I came on your show previously, and we talked about crypto and various things that ways that it is utilized and traded. And to just kind of dive into it, FTX is an exchange. FTX was one of the larger exchanges in the world. They have different subsidiaries in different countries. It was run by Sam Bankman-Fried, and they've had some issues lately, as many centralized exchanges seem to run into with liquidity runs on withdrawals, basically, where essentially users are starting to withdraw their funds, and the exchange, due to various reasons, essentially mishandling of users' deposits, is unable to cover their sheets and make sure that the money that was supposed to be there to pay their customers and their withdrawals is not. And that's seems to be occurring with FTX. And there were a couple of ways that they had potential parachutes and other big names in the space tried to save them or provide them ways out. And as of this morning, it looks like none of that has been successful. And the way that this is kind of important for users is that anybody whose funds were on that exchange, uh, they're heading into bankruptcy. They've literally like filed for bankruptcy. Who knows if any of those users are ever going to see their funds. And something like this is why I wanted to bring John on as an expert in the field, is because John, you've been around for a long time, and you know the perils of centralized exchanges and the importance of self-custody of crypto. And so what are your thoughts on everything that's happened with FTX and Binance, and how Bank Social and Financial fits into this world of helping people to stay safe in times like these, where we see one of the largest centralized exchanges in the world go belly up?
So, to really understand what's going on, you got to understand Mr. Deep Fried. So if you don't understand the history of Sam Deep Fried, you don't really understand what's kind of going on here. So Sam started as an arbitrage trader. He figured out early on, I can't remember the exact time, like 2014, 2015, that he could basically, as Tether and all that was coming online and prices were starting to get set, on based on the ledger and the price it was being traded at, he figured that he could buy stuff in China at 2 a.m. and sell it in the United States at whatever time it is, because it's cheaper in China because everybody's sleeping, and then he could sell it for more in the United States, whatever. So that's what he was doing. So he started as somebody who was trying to play markets, right? Then they got into the whole, we want to save your crypto and we want to be this and his whole, well, I'm a good person because I'm gonna eventually one day give away all my money to the cause that I deem worthy, right? Like we should praise Mr. Deep Fried for being very philanthropic there. the whole thing is basically just been from that guy from the beginning. And I think we see it from, a lot of these guys. They just, the way they make all this money is by holding, custodying people's crypto and, doing what they will with it because you've signed an agreement that says that they can and you don't know it. And really, this is the whole reason why crypto was created. Crypto was created to remove you don't need a middleman. And really that's kind of where we are. And Michael, I'm always been a big preacher of all this. It's like that's what crypto was created for. And these guys have just been kind of the slick marketers. I mean, you hear people that say that these exchanges haven't changed in 4 or 5 years, and they haven't. They've been the same exact, minor upgrades and change. But the whole idea was get as much of your crypto as they can so they can amass fortunes, take those fortunes away, while holding your crypto in unregulated markets, right? Because it's almost like a deposit for the most part when you're not holding your own crypto. There's a difference between DeFi staking, where you're in a smart contract that has open source code that you can read and people can audit, and it's got some, public verifiability behind it. And it's a whole entirely different thing to go put something on some centralized exchange that they call whatever they want. Really, what it is just them taking your money in an unregulated way and then using it for whatever purposes they want. And so, I think that the good news is, like, there's a silver lining here. We're getting to the end of the road on, the people that are out there that can make these types of market moves. Like, there aren't very many more big exchanges to go down. You know what I mean? For this new rebirth to occur. You've got people like Coinbase who, look, Coinbase has been a lot more restrictive with who they, what they sell, how they do it. I think they've been a little bit more above board with Circle and what they're doing there. So, they're kind of they're the evolving piece, and I think we're at this transition now. It's really a great reset for the whole decentralization movement, because it's actually teaching, I saw some stuff from VCs. I mean, look, I talked to VCs. There's a couple that I won't name that have, told me some outlandish stuff. One of them just a few weeks back told me that, custody is where it's going to be. Sam Bankman-Fried has the market corner. And I was like, all right, brother, have a good day with that one. I literally got up and walked out of the office, and we never talked again. They were telling me how, you've got to go into custodialship. And I was like, you don't even, and they wanted to know, like, we're working on some algorithm to decentralize some stuff for security and safety. And they wanted me to tell them how it works. And I was like, yeah, you don't get that. You think custody is the way to go? You think Sam Deep Fried is the future? Go bet on him, So, I think
See
they
how
did.
that
And
would have gone for them.
well, they did bet on him. I mean, they told me that they were basically already invested in that. And, that's what they saw. And if we could make some switch to custody, they would think about it. I was like, yeah, we're not interested in doing that. I just saw an article written by a writer at TechCrunch. Her name escapes me. She's a really good writer, especially in the crypto sphere. That talked about how VCs are now saying, oh, wait, maybe we were wrong. Maybe this is about decentralization and figuring out how to just, allow people, like, the new features are going to be to allow people to decentralize themselves, and so that's how it's going to have to be. You're going to have to provide value in the decentralized world. And the good thing is that people are starting to understand what that means. It's not just using a cryptocurrency. That doesn't mean you're, I got some. That's not decentralization. So
No.
it and again, I think it's really good that this happened. Now, what sucks is that it's taking kind of the wind out of the sails when the wind was already not very, there wasn't a lot of wind blowing around and people were already kind of deflated. What I will say, though, is that there seems to be a lot more information flowing around. I don't see the sentiment as negative as it was, for example, when Terra went down. Right? When Terra went down, it was like, oh my God. And this is probably, a 10x on Terra Luna. This is massive. This is on a,
Yeah.
and I don't see a 10x response.
FTX was what, like $9 billion in the hole now or something from everything that they went with Alameda, supposedly with funding Alameda's trades and things like that. So It's a
Yeah, they
big,
were actually
it's
they were
huge.
trading against their own. They were trading against their own customers. And when you do that stuff off chain, you can't really see it. See, they're not doing anything on chain. They hold a few wallets, they hold everybody's crypto, and then they just tell you that you have this much crypto. It's all a facade. Most people don't even know that they're not that when they see a wallet address, that doesn't mean that it's their wallet. It's just a wallet address. If you go actually watch what's happening on the blockchain, they move it out of that wallet directly into a centralized wallet within 2 seconds. It's gone.
Yeah, because it's not the users anymore. It's on the exchange.
Exactly.
They have control of it.
So
They have
let
custody.
Exactly.
let me rewind just a little bit here. So we're talking about FTX, which is a centralized exchange. So if I'm just your average,
No, don't call it that. Don't call it that. Let's start making a differentiation in the verbiage we use. That's a custodial exchange.
custodial exchange. So what does that mean?
That means they are custodying your token. So there's two different types of custodialship. There's self custody, where you custody your own, you yourself custody your own stuff, your own digital assets. And then there's custodial, where somebody else is custodying your assets. And they're just giving you kind of a written promise that maybe if they have enough money one day, they'll pay you back. It's worse than a bank IOU from the Fed.
Would you say that the average E-Trades, TD Ameritrade account owning just regular stocks and
Those
ETFs,
are custodial.
so it's the same, it's
That's
the same kind of
custodial.
a thing, right?
It's the exact same kind of a thing. And don't tell me they're not leveraging your Fidelity account against something else. They absolutely are. You've got money in there. Um, it's just they probably have more people focused on finance and not making as many dumb moves as Deep Fried over there.
Mm-hmm.
So an example of that is like basically, a year ago, everybody got really, really into crypto about the whole Doge with Robinhood. Like it was available on Robinhood, and that was essentially custodial because Robinhood shut off withdrawals. Like when like Musk did his
Well,
thing
let's
on
not even.
SNL.
I mean, Michael, it's not just that. Let's get out of crypto entirely of why custodianship is not good. I mean, look at what Robinhood did with stocks, with GameStop, and
They stopped. They they
Yeah,
closed the
they
buy
control.
button.
yeah, they closed the buy button. They said, turn it off. Turn it off. You can't do this to us. It's like, wait, I thought it was my money. I thought I was trading my money here. And that's what's been perpetrated on people for the last 6, 7 years, is that this custodianship is a good thing because you have crypto. It's decentralized. Ugh, it's decentralized. No, that's complete and utter bullshit. And I'm so happy this happened because it's putting it right out there. And it's the same thing with stocks. And so what's going to happen is now stocks are going to be tokenized, and there are going to be open exchanges. And Fidelity and all these people don't want it. They want you to think that you need them to custody your Bitcoin and your new digital assets. You won't. They're going to have to change their model, or they're going to die.
Yeah, I mean, because you talk about the dark pools and off exchange, right? I mean,
Exactly.
going back to the whole eliminating the buy button with a couple of these companies, meme stocks. Some of these companies are trading at 70% off exchange, and I even Gary Gensler, the head of the SEC, is talking about how the huge majority of retail trades are constructed off exchange, not even to the lit markets,
Look,
which have no
I
effect on
feel
buy
for
pressure.
Gary. I feel for Gary. Everybody else, a lot of people don't like Gary. I very much feel for him. That is a tough fucking job. Think about what he has to do. That guy has to police markets that he has very little visibility into. Do you understand how easy it is for a fucking developer somewhere to go into a database and change a record? Right? That can't happen with cryptographically tied together ledgers, especially if they're public. Even private blockchains that can be put behind, firewalls and put inside of DMZs to protect them, they're still cryptographically signed. And so I feel for Mr. Gensler, quite frankly. In the beginning, I was kind of like, well, why isn't he doing? And I'm like, I understand why he can't do more. He comes out and says it all the time. It's just how's he going to go if some CEO walks into the dev shop and says, "Hey, you two, I need you to fucking wipe all that shit clean." Come on, it's going to take fucking forensic experts. And if you have enough time and you know what you're doing, you're not afraid of that kind of shit.
Yeah, and just one thing that's popping in my brain as you're talking about that. I mean, it's like doing your job with your hands behind your back tied, and your feet and your mouth tied behind your back. I mean, you're robbing Peter to pay Paul. I mean, all of it's interconnected. And like when you're talking about short selling,
Oh,
I mean, you're talking about just ledgers and data points, and it's a lot of it's self-reported, right? So like if you execute a trade and it goes out and you're self-reporting if it's long or short, and like what the hell? Like I don't know. It's just crazy.
Kramer. I saw Jim Kramer, that guy.
Oh yeah. Oh yeah.
So that guy was on John Stewart or somebody, and they asked him, why'd you say this? And it was basically him saying that he shorts against himself. He plays against himself. If markets aren't moving, he gets enough money to go out. And it's just like, that's okay. Okay, you know what? If it's not illegal, I just want to be able to see it as a user. I'm getting fucked because I can't see it too.
Yeah.
You know,
I think
like
I
he
saw
can do
that.
all that
He
behind
was
the scenes.
and then like affect the news headlines and the news stories because they're all interconnected somehow
Exactly.
with the institutions
Exactly.
and whatever.
Exactly. And so I'm like, you know what? If you're doing that, I just want to be able to fucking see it. You know what? If it's not illegal and everybody should have access to it, I just want to be able to see it or write programs to see it.
So the whole point, like you said before, the whole point of crypto was to be able to have it on a blockchain, on a ledger. It's public, decentralized, and now we're talking about custodial exchange. What it is Coinbase custodial?
All
Or
custodial, all custodial, all custodial.
okay,
Their model, almost exclusively around the world, the model for exchanges is custodial first. And the reason why is if they don't have to convince you because people don't really know that there's another way, right? Which is why we created what we created, a self-custodial exchange. So we're self-custody first. Look, I believe there are times where somebody should be like, hey, look, I'm willing to risk this self-custody crypto asset and go stake it on some centralized platform. It doesn't even have to be decentralized. It can be centralized too. And I'm willing to stake it there. Now I know though that I've staked it, there's disclosures and you're properly warned. Versus now it's just everybody's crypto is in that pool. Nobody's told anything. And the few bad trades that they do result in these types of results, or the many bad trades that they continuously do result in these results. So yeah, I mean, most of the exchanges around the world are custodial.
okay, so there really isn't any major exchange that's completely decentralized.
There isn't, and that's where we're coming into play. So we're starting to make some big waves. I can't really talk too much about the stuff that we're doing just because we're still under stealth with some of it. The idea, though, is the shift to self-custody and making self-custody easy and transparent for people, simple. And that's what we're going to do. That's what we are doing.
So there's talks of, hey, well, FTX, they have your money, they have your crypto, they put it into their own wallets, as you're saying, and then he went and did risky stuff with the money, or risky stuff with the actual coins or the tokens. What does that actually mean? What are we talking about here? Like what they have your actual
leveraging
coin, and then
yeah,
what are they doing with it? Leveraging it.
Yeah, so they're going and leveraging it to go. I mean, some of them are staking into DeFi, so they have a just various things that they do with these tokens, right? From lending it to other exchanges, so they'll buy tokens with some. I mean, how many times have you heard in the last year and a half, 2 years that FTX is putting up $1 billion to this ecosystem or this? Well, that's what it's used for. It's used to pump money into that ecosystem, right? That Solana or Polygon or whatever. It pumps money into that ecosystem. And so as those ecosystems ebb and flow, so does their balance sheet. And if they make up, so that's one of the ways they do it. They go stake into these DeFi lending pools. They do traditional assets. I mean, they're all over the place. And they're just taking how bad did they get burned in the Terra Luna debacle? I'm sure they got fucking burned. They're just private and they didn't really, they didn't go down yet, so they didn't have to disclose. Now they're going to have to disclose.
There's a term that we keep using, staking. Joel, are you familiar with that? Or John, if you can just kind of go over like staking. What staking is?
It's a money market on-demand deposit account. So basically it earns yield and you can request your money at any time. It's a deposit account. They just can't call them deposit accounts because they're not banks, and those words are made illegal by banks at the legislative level. So staking is just yield deposit by another term, and you can have like a 6 month CD. You can have a 6 month staking pool. You can have a daily accrued staking pool where you can pull your money out at any time that accrues daily, or you can have a 12 month, a 1 year, whatever, year and a half. So it's just like a CD staking pool, used interchangeably.
And they're able to generate those returns to pay out because they're making money they're making money on your own money in other places. Is that right?
Well, that's not necessary. That's yes, sometimes, so in that model, you got to look at kind of what the model is for how it produces income. Okay. So on something like, there was this one token called, I can't remember what it was, stat no loops or something like that. It was some music guy released it, and it was basically paying like 90% APY. And it's like that doesn't really work long term.
Yeah.
And you got to know that, or you got to know how it's being funded. Like in that case, what they were doing was they issued half the tokens, created a liquidity pool, and then they kept issuing the other half of the tokens as a high yield. Well, that really is unsustainable. That's like probably one of the worst models of sustainability. There are other models, like we're about to release a coin where we already released the coin. It's a stable coin. It's the first one-to-one. Basically, falls in line with U.S. regulation for how you have to do this stuff. And we're going to have staking pools, and the way those are getting funded is cash from VCs that they're putting up. I mean, essentially is the way that works for a period of time. And then it also, though, long term, there are fees generated off the exchange that get shared with all the pool holders. So there's a sustainable model there as trades come in. And this is more of a DeFi stake. So there's not a centralized entity that you're giving your tokens to. You're giving them to a smart contract, and the smart contract is managing the rules that everybody plays by, which is a fair game. It's more of a sum zero, because everybody who wants to can understand it. Nobody's given a direct advantage.
Can you explain what DeFi means and how that's different than what we're talking about with custodial?
So yeah, DeFi is decentralized finance. So when you remove that intermediary aspect of things and you make the intermediary not technically a person pushing a button, rather code executing, and then anybody can execute those set of codes with anybody, you can put all kinds of rules in there. So decentralized finance is just one component of distributed ledgers and then this new decentralization movement. The other thing is like digital IDs. So digital IDs are going to start to become a thing where you self-custody your data, and then people pay you for your data and companies pay you for your data. That's about to happen. And so decentralized finance really becomes the underpinning, the power underneath this new financial network that's spinning up.
Okay. So I read something where some of the two big market makers in the stock world, Virtu and Citadel, this kind of fits back into the Robinhoods of the world, E-Trades of the world, that I think Robinhood would, like, 70% of their revenue was based on payment for order flow. So they would basically be taking all the trades and putting them through Citadel off exchange, and they're generating, all the revenue from that. So how does that work? So if I'm an end user and I go on Robinhood, for example, and I pay no commissions, which that's great for me. That means I can make more trades.
Well, it's arbitrage. It's cost and marketing. I mean, there's a lot of different ways they chalk that up, right? So arbitrage is one way. They hide a little in the arb of what they get the cost of the stock for and what they sell it to you for. Okay. They chalk some of that up to marketing. And then there's some of that they're on the backside, leveraged paying for. The risk, that's where the big risk comes in,
Okay. So if I'm just a regular Joe out there and I hear about crypto and I want to go get in the game, it's come back down. Maybe this is a good time to get in. Maybe this is the bottom. Maybe it's not. I'll just dollar cost average in over a period of time. the average person know whether they should be putting their money into a Coinbase versus an FTX that's now going bankrupt or any other exchange like that?
Well, you shouldn't put your money in any of those. You should get a wallet like the bank social wallet. There's several of them out there. That's a custodial wallet. And the way you know it's custodial, here's the way you'll know. Okay. When you start up the wallet and create an account for the first time, you'll be presented with the opportunity to save your private key. So you'll generate in real time on your device with cryptography a public and a private key. And the private key is essentially the password to your digital assets. That's how you'll know that you have your keys and you have your wallet.
Okay, my sister was telling me something about I guess it's KuCoin. What is that an
It's all
example?
custodial.
So that's
No, that it
custodial.
look,
Okay.
all of them are going to be custodial. The vast majority of them are going to be custodial, you
Okay.
know?
If you're interacting on a website and it's living in the website, it's custodial.
Well, I don't want to go that far. The way you know that it's custodial or not is the private key. That's how you know it's
You don't
custodial
have
or
it.
not.
You don't have control.
Yeah, there are web versions that can spin up. So our bank social site, you can spin up a wallet on the web in real time, and it does that on your local machine with cryptography on your local machine, so it can't be intercepted. That can still be, it can manifest itself in many ways. For example, there are some Bitcoin ATMs that will print you a receipt that if you don't have a wallet, they'll create a wallet for you in real time, and that's called a paper wallet. And then you have 12 words on that or 24 words on that piece of paper on that receipt, and then you can take that to a hot wallet, like a web-based wallet on your phone, and you can input those 12 words on your phone, and now you've migrated the viewership of those tokens on the chain into your other device, and you can do that whenever you want, right? So one case here, like, okay, well, what does that mean? Well, let's say you're in the Ukraine and you're a refugee, right? And you've got your money on it. Let's look at two scenarios. The first scenario is the FTX Coinbase scenario. You've bought, or KuCoin. You've bought your coins, they're on KuCoin. Now you're going across the country, you're in a different banking system, you're in a different ecosystem. Now you've got to, maybe you can't get onto KuCoin because it's being blocked by the local government because they're trying to do something. Well, you're pretty fucked. You can't do anything with it, right? Now imagine you're the same refugee and you memorize your 12 words. It's only 12 words. It's not that hard. You can have your kids memorize. You can highlight words in a book. I mean, there's 100 different ways you can walk across the border with the keys without anybody knowing. And then when you get to the other side, you can literally walk up to somebody and say, "Hey, will you take half a Bitcoin for something? I really need something right now." And you'll find somebody, I guarantee, somewhere who will say yes. Yeah, they will say yes. And so, and even if not, maybe you get to that country and now you're like, well, hey, I've got internet access again, and I do want to get on, and sell a little bit on some exchange just to sell a little bit. You can do that with a different exchange. So there's so many more opportunities when you own your keys and you own your assets. Does that make sense?
It does, and like this is just mind blowing to me. Like the whole purpose in my small brain is okay. Why does crypto exist? You're talking about blockchain, and it's all digital, and it's all public and available, and it's decentralized is what's in my brain. Now we're talking about custodial accounts, and then you don't actually have your own wallet. It's just like the stock market exchange, essentially. How is that even? That's mind blowing. I thought that
But
that was the whole
it
purpose
happens where
of
they made
crypto.
it easy. It was the all these custodial exchanges essentially, John. I mean, I think this is where I'm getting that it was made easy for the user by taking away some of your control and giving it to the exchange. You made it easy for the end user, but the end user didn't realize that they didn't actually own their crypto. Right?
Yes,
You make the interface.
I would also say that they marketed more. then they took a lot more money in the VC. I mean, it comes back to what I was saying in the beginning. The VCs now understand that decentralization is the way to go. So basically, they took a lot of VC money because they built something early. They took a lot of VC money and they said, "Hey, look, if we can get these people to give us their crypto and market to them to give us, I mean, the exchange interfaces are not that great. They're kind of shitty, actually, some of them." And some of them are super, like we were talking before, super old. They're not great. They're pretty bad. Yeah. And even funnier, it's all forked from like 3 different versions. So like 2 or 3 guys built versions of crypto exchanges, and then all the other exchanges fork those exchanges. So it's literally copy and paste. I mean, go look at KuCoin, go look at Huobi, go look at BitTrue, go look at all of them, and they all like little different interfaces color wise, but almost all the same pop-ups happen at the same time, and everything. That's not just coincidence, or that's not just them trying to be like each other. It's actually the same software that got forked 500 times, and that's why so many exchanges just kind of popped up. So, it was really a derivative. Why did this happen? It's really a derivative. I'm not going to blame VCs, because I think VCs just, they're putting money where they see returns, right? And they're relying on the entrepreneurs to do this. I don't think they're in the room necessarily, doing a lot of those decisions, especially in the beginning. Certainly, though, they now understand that the vast majority of them are going to come out of this and say, no, we need to power the decentralization. That's actually what this is. It's like, yeah, guys, they tried to kill distributed ledger technology over the last 3 or 4 years. They've been trying to kill that word. They've been trying to focus on the word crypto and the word Bitcoin. That you don't even see other like ETH and all that kind of stuff. Because once you find out how something like ETH works, you're like, well, why the fuck do I need Bitcoin? So it's like there's this whole agenda that's been happening, and now it's losing power big time, because people are starting to understand that, well, shit, I thought I want my crypto. What do I need to do to hold my crypto? And that's where we are right now. We're literally right there on the edge.
So if somebody wants to dig deeper into where to get into a decentralized exchange, it's not custodial, are you saying that they can get into Bank Social's website and then get into a wallet? Can you explain that one more time?
That's a way to do it. Yeah, you can go to the banksocial.io website. You can download our wallet. You can go to our exchange. You can buy crypto. We've got our Telegram is probably one of the better places on the decentralized ecosystem to live, because there's a bunch of great people. Michael's in there all the time, always talking to people, making sure nobody's getting scammed or keeping scams down, and giving a safe place to learn, understand, talk. We've got a bunch of educational videos. We're redoing our educational series right now. It's like 15 videos. It's going to be really great. It actually is really great right now. So yeah, I mean,
that's currently on your website. Where would they find those educational videos?
No, the educational videos, I think most of them are on YouTube right now. We are migrating them to our So if you go create an account in our my.banksocial.io section, those will live there in about a week or 2. Those will be living back there as little tiles that you can kind of go through.
But right now it's on YouTube.
Yep, in our YouTube.
And they would just basically search for Bank Social. Okay, and they can find that. Okay, cool.
Yep.
And then
people are trying to get like direct contact to like talk to our community. The easiest way is like John was saying, through Telegram. That t.me/banksocial is the direct link to download Telegram and get the like right into our channel, where the community talks to each other and answers questions, and the moderators try to keep things down and keep things safe for the users.
We'll definitely get these links when this gets posted. We'll definitely get all these links and put them in there. Make it easy.
Yeah,
that's awesome. So just for our listeners, where can they find you on social media?
Yeah, you can find me at President HODL on Twitter. So I'm most active on Twitter and LinkedIn. On Twitter, I'm President HODL. Hold on for dear life. Hold on for dear life.
That's right. And Michael?
And I'm at Seeker of Coin on pretty much all the platforms, and definitely on Twitter. And I would definitely recommend people follow us on Twitter, follow John on Twitter. And if you want more of this like serious education stuff. If John's doing a Twitter Spaces, it's definitely something that you should be listening to. He's got some great Twitter Spaces that he puts out there.
Yeah, I have the alerts on my Twitter to make sure that when that pops up and you're going live, and your actual tweets, I have alerts that come up because I definitely want to see those things. So they alert me whenever you post. So thank you on that.
Yeah.
I guess when I talk to an investor, right? You've got multiple things that you can invest in. You can invest in the stock market, trading, long-term ETFs, real estate, crypto, NFTs. There's so much out there that somebody can decide what to put their money into. And some of the financial advisors out there, I've seen publications talking about, well, hey, put 5%, 10%, whatever percentage that you think is a um, um, a diversified percentage to put into crypto. When you look at this as a long-term viable tool to be able to build wealth, how does this all play out in 5-10 years?
John, I'll definitely let you answer this because you've been in the space long enough that you've seen this firsthand. So this is definitely something for you.
Okay, so in the next 18 to 24 months, you're going to start to see the move to digital identification for this kind of stuff. Because now people know that they need decentralization. Businesses know, governments know, they know all this. So the next move to make that work, you can't be anonymous. That's one thing. You can be sovereign. You can't be anonymous. Nobody wants to deal with anonymous people. That's a fallacy, and I'm not a believer in that. I do want to deal with sovereign people. And so the first move that you're going to see is into digital identity. So, I'm not going to say you need to be buying this or you need to be buying that. Certainly, look at your risk portfolio. I personally think it's a good idea to put an amount, whatever you feel comfortable with. Smart contract platforms, I think, are really the way things are going to go in the future. Being able to put law contracts, home contracts, all this stuff, and the way you're going to have to pay for the network usage is with the tokens and coins on those networks. And so owning some, it's basically like going and getting a bus card, right? You can't get on the metro. You got to bring dollars with you every time, or you can get a card, and you use that every time you get on and off the bus. So it's same type of concept. It's just going to be for everything that you do on that ecosystem. So things like Ethereum, things like Polygon, Hedera. I really love Hedera. I think it's a great ecosystem. It's a great network. So having a little bit on each one of those to be able to utilize the platform is what is going to be the most beneficial. For example, people who like to invest may find that there are some tokens like our bank social token where by getting some of that, you now participate in our DeFi lending that we have, where we lend to people or make agreements with companies for certain things, and then you get a portion of those rewards and a portion of those payouts. So there's a number of different ways to get involved. The first step is getting one of those base layer coins like Ethereum, like a Hedera, like a Polygon, and then going somewhere like the Bank Social Telegram and start to learn what you can do with these coins and how they interact with each other and how they work on chain, and start educating yourself, because you have the next 12 to 24 months to educate yourself about what's about to come. And then you're going to see the digital IDs come, and then you're going to see this proliferation. We're already talking with the Texas Land and Title Association to do at the state level land and title on public blockchains. So,
That's
then
Chain Title, right? The other company.
Yep, Chain Title is part of that. Exactly. This is at the state level, though. It's not it's not some private companies working together to try to do something. This is the state of Texas and the quasi government organization, the TLTA. In other states, Joel, you probably remember, probably heard of the ALTA, the American Land and Title Association. They're part of, they govern kind of the rules around title and closings and escrow, all that. Yeah, they're looking at this stuff. And so you need to be aware. Now, the reason why I would say be aware now is because you'll be in a position to take advantage of these systems early, right, and benefit from them long term. The reality is, in 24 months, if you don't learn about them and you just kind of let them be integrated into your everyday life, um, it'll be easy. It'll still be self-custodial. It's just that you'll have missed this kind of wave of opportunity to get involved early, you
Okay.
know? So I think that, in eventually the way bank, like with our Get Rivia token, we're working on making things to where you don't even have to know that you're, I mean, that you're self custody. You don't have to do anything different. I mean, there are some wallets out there that are just terrible the way they work. And so that's the evolution we're on now. It's going to happen no matter what. It'll be tremendously beneficial for you to get involved now and start learning so that you can start reaping the rewards when because the next ramp is going to be massive. The next,
Yeah.
next 3 to 4 years, the next ramp that happens out of this is going to be massive. So, that's my thoughts on it. 10 years happen, probably around 5 to 10 years. You're going to start to see, the majority of your banking systems and financial systems, they're going to be, more transparent. The regulators are going to have an easier time. And then by 10 to 15 years, I think we're completely flipped where 90% of the financial world is running on distributed ledgers and open financial platforms. And then 10% of the world is kind of in that traditional paradigm still, because they just haven't had the need or the want to move away from it. Some of the older systems and, maybe dying economies, dying industries.
So you mentioned the word earlier, staking, and then there's a word deep pegging. I remember seeing this on, was it you said Tether?
That was Terra Luna.
Terra Luna. Okay. And I think I saw something also on another one that, hey, this thing got deep pegged on the USD or whatever. What does that even mean? And what are the risks involved with something that's pegged to something
So that
else?
was a stable coin. Terra was a stable coin, TUSD. And Terra's problem was, and I said this, probably it's been over a year now. I think I'm on a public.
It was a logarithmic one, right?
Well, it was more than that. The problem is it was like triple logarithmic. So you had three coins doing a balancing act where one coin would buy and set would mint and burn itself based on the price of Bitcoin and the amount of holdings. And then there was another middle coin in there, their Terra or their Luna coin, that was pegged against the US their Tether USD. And so what people figured out, or I think they knew it very early on, these probably big hedge funds and stuff, is that when it gets to a certain point, if they have $5-6 billion to throw at the market for a few seconds, they could tank that thing based on how the algorithm works, because it couldn't keep up. Because now you can trade at the speed of light with code, or near the speed of light. So, and then if quantum computing comes in, maybe as fast or faster than the speed of light. So when that coin and the price of Bitcoin being tied together, when these people came in and sold a shit ton of Bitcoin, the price of the Luna started to depeg because it was tied to the Bitcoin, and then the price of Terra started to depeg, and then they bought the Terra when it went down to like 30 cents. They bought the USD coin at 30 cents, and then the guys at Terra Luna refilled their Bitcoin bags to restabilize the price to get it back to $1. Then they dumped a whole bunch of dollars on the market, which meant that there wasn't enough to cover the spread on the other side of getting the money out. So that messed up the whole equation again. Then they dumped more Bitcoin, which messed up the equation. And then by that time, they did that rinse and repeat 3 times within 5-10 minutes, and it was completely done by then. They had the Bitcoin backing that they needed to keep the dollar pegged to, based on how much was outstanding to the people that owned the Terra Luna. There wasn't enough to cover the stable coin. And so that whole system was just wrecked as a part of that.
And that's only possible in a custodial account.
Well, no, that's possible in any place. I mean, that happens in stock markets, that happens with companies, that happens everywhere. That's only possible on a stable coin when it's algorithmic.
Got it.
So
That's
the way
where
our Rivian
Rivia,
stablecoin is, the way our Rivia stablecoin is built is because we work with credit unions and it's not for profit. We don't have to make these stupid, ridiculous, outrageous VC, returns on this stuff, 100x, 500x, these ridiculous promises. It still can be a very profitable entity. It's more so there to help people, to remove friction from their everyday lives and cost and lower cost, right? Make it easier to transact with each other. And so that is backed one-to-one. So every time somebody gives $1, even Circle is not one-to-one backed. So USDC, it's not one-to-one backed. Every time you buy a USDC coin, they take 70 cents or 60 cents, whatever it is, they throw it in a bank account, and the other 40 cents or 30 cents is leveraged somewhere. So, okay, it's better. It's a little better. It's still not one for one backed. Well, the House Financial Service Committee is actually in the process of releasing a bill that you will see here probably in the next 12 to 20 weeks. That's going to make it mandatory for stable coins to first not be owned by banks and we've been working with several people on this to make sure that this is written correctly. They can't be working with banks. It can't be a bank issued stable coin, and it can't be a credit union issued stable coin. It has to be a company it can be owned by a group of credit unions or banks. And it has to be one-to-one verifiably backed. That's one of the big key components of that. So all these other, stable coins, they're not going to be able to get there very fast. And maybe to things like Tether, with Tether where it was born, it may never get there. It probably won't get there, So that's why you see people getting out of Tether slowly. I think a lot of people are still kind of jaded that it won't happen. It's happening. It's coming. It's going to come. And so a lot of governments, once they realize that they kind of let this get a little far out of hand, I think they're going to, they're not going to round up the reins of the entire crypto market. That's just too big. That's just too much of a challenge. They're going to start to go after the things they should, which are things like these exchanges that are not being up and up, right? And acting like bank accounts that aren't disclosing shit. They're going to go after stable coins, which is rightfully so. I mean, you buy a stable coin for it to remain $1, not for it to go down to 38 cents. So I think those are the next big moves on the government's radar. I think they're going to go after digital IDs so that they can make sure that there's sovereignty and trackability and verifiability of who did what. That's what the short-term future is here.
A lot of good stuff. I know we're running out of time here. If you have one piece of advice that you would give to somebody right now in this market, what would it be?
Your keys, your crypto. Get your crypto off of centralized exchanges. If you don't have the private key, it's not yours. You just gave your money to somebody and you're hoping they give it back to you.
Unbelievable. Yeah. This is educational for me. And I'm watching this stuff, more than probably the average person is. This is amazing stuff. I have to have you on again at some point in time. I know you have a very, very, very busy schedule, a lot of things going on, but maybe down the road we'll have you back on again and dig into some more of this stuff. But, you mentioned 12 to 24 months, there could be a big opportunity. Love to dig into that a little more of some of the range of things that people need to be aware of to capitalize in a risk, minimal risk type of way. But John Wingate, Michael, go ahead. Yeah, you got something?
No, I agree with John there. The definitely your keys, your crypto. If it's not your keys, it's not your crypto. The exchange is going to do what they want with it, and you could end up completely upside down with no access to your funds. And the other thing that I would say, as far as like one thing for people, is to do your own research. Like it's all the more you can research and learn from resources and from the truth, the truth sayers, not just personalities on Twitter and things like that. Find the people that are educated in the space, like John and some of the other folks that I've been able to find, and listen to what they have to say, because they're generally going to have the real truth, not just some hype about something.
We're definitely gonna need to put a couple links in the description of some of these tools and places to find the educational pieces of information. So this is awesome stuff. Guys, thank you so much for coming on at short notice. This is just something that would just hit. So I want to get some basic information out there for listeners. And John Wingate, Michael Allen, thank you so much again, and look forward to talking to you soon.
Thanks so much.
See you guys.